This conference will now be recorded.
Hey everyone, thanks for joining our third week of the Prepare for VC presentations to the Found Something group. Today we're going to be talking about funding opportunities and different types of financing for your startup company. So the first option is traditional banks. This is great for more established companies or businesses that have some sort of collateral. So if your company owns any sort of real estate, any patents, products, that you can use the inventory for financing, then this is a great option. Most, technology companies will have, or other healthcare companies have a difficulty with this path until they actually are up and producing revenue. Once you have revenue, you can sort of use this at the debt opportunities from banks or even private lenders as additional growth capital. There are several lending sites and private lending groups that you can also use instead of banks if you're at an earlier stage and debt financing is an opportunity you're looking into for your company. One of the main ones, especially at an early stage, is angel investors. So these are individual investors that um, typically, either grew their wealth through previous companies, through sometimes their previous entrepreneurs themselves, or investors from the finance industry that now go in and decide to basically their goal is to invest in either one or a group of startups for in exchange for equity with the goal of an exit opportunity down the road. So with these investors, there's a combination in here. Sometimes they'll come from a particular background and be looking to invest in an area they can add added value, expertise, or just something they really know about and want to get behind and see as a pain point they can get behind in the industry. So targeting those when you're reaching out to angel investors and targeting those that have a particular background in your industry is definitely a key value there. You can also, a lot of times they post their portfolios on sites like AngelList or Gust or even Crunchbase. So if you can go to an investor, sort of see basically what their portfolio looks like. If is it made up of only technology companies? Is it made up of finance, or is it made up of more early stage, later stage? Are the founders they're invested in, only coming from the same college that the angel investor went in? And there's a lot of different makeups of angel investor portfolios, and basically being able to know who they are and why they're investing or what they're investing in can give you an added leg up when you're reaching out to them. So some of these do invest individually directly, like you reach out directly, they'll write a check for your company and in exchange for equity in the round. Other times they'll be part of a larger group, so that's even in the Boston area, there's at least 10 angel groups or so, like Boston Harbor Angels, Walnut Ventures, a few others that like Launchpad Medical for medical devices. Basically, yeah, a few others that there's a group of investors that come together. They're still writing their own checks, making their own investments, but these groups are formed as a way to share deal flow, share due diligence and expertise when making these decisions. So, like a typical group, for example, might have a few people on a screening team that pick the companies that come to present to the group each month. So say they're if the team picks 4, 8, depending on the group, whatever number they pick to present to the investment group, then at the larger investment meeting, each of the companies will go up, present, present with a pitch deck, usually 10-minute presentation or so, followed by a Q&A from the investment group, and then each investor, depending on the structure of the group, most of them allow any number of investors from the group to decide that they want to go into the deal or that they're just interested in following up for due diligence and working together on the due diligence package. So if there's a group of 30 or 50 individual investors and 5 or 10 of them from the group want to go into it, that core would move forward with the company and work on finalizing the round, answering any due diligence questions that have come up, um, and yeah, moving toward an investment. Some are some are more individual basis. Some pool the investments into more of a fund structure as well. And there's venture capital. So the main difference here in terms of where the money comes from is that venture capital is these firms are formed with limited partners that invest. Basically, they invest in a venture capital fund, and the fund is managing all the investments and making the investment decisions on behalf of the investors. So, and usually, usually venture capital groups will fund larger amounts than angel investors, just because because they're a pool of multiple either wealthy individuals or institutions, and generally there are some micro VCs and smaller venture capital companies, but the majority are looking at more of a or somewhat later stage than an angel round and putting more capital in. Basically, one of the main differences, so you can go through basically get all these types of funding that I had mentioned so far, but there are some startups that do better with one type of an investment versus another. So if you're basically if you're a type of company that throughout the life cycle of the startup you're going to need basically $1 million to $3 million, even a little more to basically take your company to profitability or an exit potential where you have enough users that another company will come in and acquire your company. Not highly capital intensive for the startup industry and quick to revenues basically. You can fund the majority of it through angels and angel groups. Broken into a couple rounds. If it's there's some industries where basically you don't get much done, or there's no real success or milestone until you're at the until you raise by $5 million plus to really kick things off. And for those, generally you'd be looking to start with an early stage venture capital firm and somebody that has the capacity to do a larger funding round down the road as well. Family office is another type of basically they're set up um, similar to a venture capital firm um, in terms of the structure, the types of investments, and the check sizes. Main difference here is it's an investment company that's formed on behalf of either one or a group of high net worth families. So they are like in an angel group, they're investing um, on behalf of one, like on behalf of themselves, either a family or a group of high net worth families. Um, One other difference here is that a lot of family offices have sort of built their wealth in one industry or another. So having if your company ties um, into their main area of focus, or even impact opportunities that they fund. A lot of them have foundations as well that they funded for one cause or another. So if you can tie, more of the investment focus is tied around particular interests versus a general investment thesis. Um, and again, they are still looking for financial returns, the same type of investment opportunities as a VC firm or an angel investor. But it's just within that pool, more of a focus down into the beliefs of the family office and their background and added value as well. Um, this is a crowdfunding page. Basically, the other side of this is crowdfunding. There's been a few different types of crowdfunding that have popped up over the last 10 to 15 years. So started with donation pages, sites like GoFundMe, Indiegogo. Brought on their Kickstarters, which are great for and similar sites like that, which are great for real product-based companies. Anything you can use to get a pre-sale of your either a pre-sale of your product or just something even with enough. Uh, Crowdfunding is great for impact opportunities as well. You know things people can get behind and would even sometimes they'll fund it in exchange for a T-shirt that shows their support of the um, particular company that's following a cause they believe in. Or other times they'll say, "Yeah, this is great. I'll instead of saying, when you a lot of times when you do a customer survey, customers will say, or potential customers will say, "This is great. Keep me on your subscriber list for when you." When you launch the product and I'll buy it. This way, they're actually investing through a Kickstarter campaign or something similar, and will automatically be purchasing the product once it launched. It's also great validation to take to investors and say, with a limited amount of marketing and just a Kickstarter campaign to early users, you can show them how much traction you've gotten on future sales. Another development that's come about in the crowdfunding space is equity crowdfunding. So this launched in the middle of 2016 with sites like WeFunder, Seed Invest, Net Capital. Basically, similar type of platform in that your funding from the crowd and the general public. Um, Basically, non-accredited investor financing. Main difference here is the funding is in exchange for equity, debt, or other securities. Um, so there are limits on the amount each investor can put in, depending on their income. But generally, these are sites where um, you could have people putting $100 into your campaign or more, depending on your limits. And it's also great for either consumer facing technology products, just anything. It's good for restaurants and small businesses as well. Basically, places where you can get your customers behind you as investors. Um, if they're, if they become a private shareholder in your company, more likely to buy your products, promote your products, be a power user in the future. Also, there are more traditional, just smaller investors that want to use these platforms and look for the same financial incentives that angels, VCs, and family offices are looking for as well. And um, some of these platforms provide a great outlet for that capability. Best position to be in when you're doing a crowdfunding campaign is to have a large email list or following on social media of your own that you can sort of make a large initial push, get funding, and if you can show a lot of traction in the first 24 hours to 72 hours that you launch a campaign, then most of these sites will highlight you as one of the top funding opportunities of the week and really push that campaign even further from their own database of investors and subscribers. So there's I've just touched on a few different opportunities here. There are some other alternative options like line of credit financing and invoice financing, depending on your type of business. and and again, even within each of these categories, there's differentiations on what the investor groups are looking for. So, happy to. This is something we really focus on at Prepare for VC, is targeting the right type of investor and finding the right investor for your group or your startup company. A lot of times, even the best introduction can be through connecting through a portfolio company, through an investor in the group that might not be a decision maker, just as an inroad into the group itself. So we find these people that can connect you with the right investor, and facilitate introductions and make sure you're really prepared for the VC route, with all of your funding materials put together, all of any questions that come up, you're prepared to answer. You have the slides up and ready, and you're reaching out, and you can show you're reaching out to them because they're a good fit for your company as much as you're a good fit for their type of investment. So with that, if anybody has any questions or comments, please submit them in the comment section below. And always happy to answer questions. Always happy to learn about your new company and work with you on your fundraising round.